The number you see on the screen, the one that anchors the financial news segment, the one the CEO repeats like a mantra in the shareholder call, the one that makes the stock chart jump or dive, that number is very often a carefully constructed lie. It's a piece of financial theater designed for a single purpose, to make you believe a business is healthier, more profitable, and more promising than it actually is. It's a magic trick, and Wall Street's favorite illusion is a metric known as EBITDA, earnings before interest, taxes, depreciation, and amortization. It sounds official. It sounds sophisticated. But to the most successful investor in human history, Warren Buffett, it is nothing short of a four-letter word. He has called the thinking behind it ridiculous, nonsensical, and a direct assault on financial reality. And the reason for his fury is simple. This one, widely accepted number, is responsible for destroying more investor capital, for leading more people down the path to financial ruin than perhaps any other single piece of accounting jargon ever invented. The great costly mistake that millions of investors make every single day is believing this fiction. They look at a company's soaring EBITDA and see a gold mine, when in reality they are standing at the edge of a sinkhole, one that is about to swallow their life savings. The financial transformation you are about to undergo is the acquisition of a specific kind of vision. It is the ability to see through this illusion. You will learn to be deeply, fundamentally skeptical of these misleading metrics. You will learn to ignore the noise of the television analysts and the slick presentations of corporate management. Instead, you will focus on the truth. You will learn to calculate what Buffett calls owner earnings, the real, tangible, spendable cash that a business actually generates. And in doing so, you will gain a clarity so profound, an advantage so decisive, that you will never look at an investment the same way again. You will separate yourself from the 99% of investors who are perpetually fooled by these tricks and join the 1% who base their decisions not on accounting fiction but on cold, hard, economic reality. This is the final promise of sound investing, the promise of clarity in a world of deliberate confusion. The seduction begins, as it so often does, with a story of a new era, a new economy, a future so bright it was blinding. The late 1990s. The dot-com boom. The air was electric with possibility. It was the age of the internet, the dawn of a technological revolution that was supposed to rewrite all the old rules of business. Companies with no profits, sometimes with no revenue, were coming to the stock market with valuations in the billions. The old metrics, the stodgy calculations of grandfathers like Benjamin Graham, were declared obsolete. This was a new paradigm. And in this new paradigm, a new god was crowned, EBITDA. It was the perfect metric for the moment. The story these new companies told was one of growth at all costs. Don't worry about profits now, the visionary CEOs would say. We are building the future. We are acquiring customers, laying fiber optic cable, building networks. These are huge upfront investments. Judging us on old-fashioned net income is unfair. You need to see the potential, and EBITDA was the lens that made that potential look real. It allowed companies to say, look, before all those pesky real-world costs like interest on our massive debt, the taxes we'll eventually have to pay, and the cost of our billion-dollar networks turning into scrap metal over time. Before all of that, look how profitable we are. It was a story investors were desperate to believe. Consider the case of WorldCom. Under its charismatic CEO, Bernie Ebbers, it was the poster child for this new way of thinking. WorldCom was on a mission to build the infrastructure of the internet itself. It was an acquisition machine, buying up competitors, laying thousands of miles of fiber optic cable across the country and under the oceans. The capital expenditures were breathtaking, in the billions upon billions of dollars. The debt taken on to fund this expansion was monumental. If you looked at WorldCom through the lens of traditional accounting, through net income, the picture was often grim. The company was bleeding cash. But that wasn't the story Wall Street wanted to hear. And it wasn't the story Bernie Ebbers was telling. The story was about EBITDA. Quarter after quarter, WorldCom would report staggering growth in its EBITDA. Analysts would cheer, the stock would soar, They were looking at a number that deliberately ignored the two most important costs in WorldCom's business. First, the interest on its mountain of debt. And second, and far more insidiously, depreciation, the accounting term for the simple, physical reality that their multi-billion-dollar network of cables and switches was getting older, less efficient, and closer to obsolescence every single day. By using EBITDA, they were effectively telling the world that this massive, decaying asset had no cost, that it would last forever. It was a fantasy. Meanwhile, in Omaha, Nebraska, Warren Buffett was being ridiculed. He was called a dinosaur, a man who, quote, didn't get it. He famously avoided the high-flying tech and telecom stocks of the era. He watched companies like WorldCom report these fantastical earnings numbers and simply shook his head. He knew that the story they were telling was a lie. He knew that laying cable cost real money, that the debt had to be paid with real money, and that the equipment would have to be replaced with real money. He wasn't looking at the fantasy of EBITDA, he was looking at the reality of cash flow. He saw companies spending $1 to get 50 cents of value and calling it a victory. The market, in its mania, loved the story. Buffett, in his wisdom, respected the math. The allure of EBITDA is that it simplifies a complex and often harsh reality into a single, optimistic number. It allows management to paint a masterpiece of profitability while hiding the rotting canvas underneath. It feeds one of the most powerful psychological forces in the human mind, confirmation bias. Confirmation bias is the tendency of the human brain to search for, interpret, favor, and recall information in a way that confirms or supports one's pre-existing beliefs. If you've already bought into the story of a company, the visionary CEO, the revolutionary technology, the promise of a new era, you desperately want to find evidence that you made the right choice. EBITDA is that evidence, served up on a silver platter. It's the number that lets you say, see, I was right, the company is phenomenally profitable. It allows you to conveniently ignore the billions in capital expenditures listed on the cash flow statement, because that number is complex and frightening. It creates cognitive dissonance, the mental discomfort experienced when holding two or more contradictory beliefs. The belief that this is a great company clashes with the fact that the company is burning through cash. EBITDA resolves this conflict by offering a third, false belief. The cash burn doesn't matter because the core profitability is so high. It's a psychological painkiller. It numbs the investor to the unpleasant reality of the business. Management understands this. They know that if they lead with EBITDA in their press releases and on their conference calls, they are playing directly to this bias. They are giving the market the number it wants to see, the one that confirms the existing narrative of success. It's a willing conspiracy between hopeful management and even more hopeful investors to ignore inconvenient truths. This is why it's so pervasive. It makes everyone feel good, right up until the moment the bills come due and the entire illusion evaporates. To protect yourself from this grand deception, you must install a new mental model in your mind, a piece of cognitive software I call the reality check filter. It's a simple three-step process that you must run automatically every single time you see the letters EBITDA. The goal is not to understand the nuances of the number, but to immediately challenge its premise and expose its fiction. Step 1. The moment you encounter EBITDA in a press release, an analyst report, or a news article, a red flag must go up in your mind. Don't accept it. Don't analyze it. Your immediate, reflexive thought should be, they are trying to hide something. What is it? This initial skepticism is your first line of defense. It inoculates you against the seductive power of the number. Step 2. Immediately locate the company's most recent statement of cash flows. This is one of the three main financial statements, along with the income statement and the balance sheet. Ignore the others for now. The statement of cash flows is where the truth lives, because it is much harder to manipulate the flow of actual cash than it is to manipulate accounting profits. Scan down to the section called Cash Flow from Investing Activities. There you will find a line item usually called Capital Expenditures or Purchases of Property, Plant, and Equipment. This number represents the real cash the company spent in the period on buying and upgrading its physical assets. The factories, the machines, the computer networks, the delivery trucks. This is the cost that depreciation is supposed to account for. This is the cost that EBITDA pretends doesn't exist. Step 3. Compare the two numbers. Place the vaunted EBITDA figure next to the humble capital expenditures figure. Now ask the critical question. Is the amount the company is spending to maintain and grow its physical assets a small, trivial fraction of its EBITDA, or is it a large, significant portion? If a company reports $1 billion in EBITDA, but it had to spend $800 million on capital expenditures just to stay in business and remain competitive, then that $1 billion is a phantom. It's a mirage. The real cash profit is a fraction of what they claim. The final part of the filter is a qualitative question you must ask yourself. If this company completely stopped spending on capital expenditures tomorrow, would its business be viable in 5 years? For a company like Microsoft, which spends on servers but whose primary asset is software, the answer might be a qualified yes. For an airline, a railroad, a manufacturing plant, or a telecom company, the answer is an unequivocal no. Their assets would literally crumble. Their business would cease to exist. This filter forces you to confront the physical reality that EBITDA is designed to obscure. It drags the conversation out of the realm of accounting fantasy and into the world of cold, hard cash. The path of the 99%, the road that leads to financial disappointment, is paved with the unquestioning acceptance of EBITDA. This is the path of the EBITDA growth chaser. Let's imagine a typical retail investor, let's call him Frank. Frank works hard at his job and has managed to save some money for his family's future. He wants to invest it to achieve some measure of financial freedom. He turns on a financial news channel. An analyst comes on, his voice filled with excitement, talking about a hot new company in the cloud computing space. This company is a monster, the analyst says. They are showing 50% year-over-year growth in EBITDA. The stock is trading at a reasonable 15 times EBITDA, an absolute steal compared to its peers. Frank is intrigued. 50% growth sounds incredible. 15 times sounds reasonable. He hears the ticker symbol, he pulls it up on his phone, he sees the stock has been on a tear. This is confirmation. The fear of missing out, another powerful cognitive bias, begins to creep in. Frank doesn't download the company's 10K report. He doesn't look for the cash flow statement. He has a full-time job, a family. He trusts the expert on TV. He sees the headline number, EBITDA, and accepts it as truth. He buys the stock. For a few months, it works. The story continues. The EBITDA numbers keep growing, and the stock keeps climbing. Frank feels like a genius. He's participating in the wealth management of his own future. But under the surface, something is wrong. The company is building massive data centers to power its cloud services. The capital expenditures are enormous, almost equal to the entire EBITDA figure. The company isn't generating any real cash. In fact, to fund its expansion, it's taking on more and more debt and issuing new shares, diluting existing shareholders like Frank. One day, the growth story hiccups. A competitor announces a price cut. The company misses its quarterly EBITDA target. The narrative shatters. Suddenly, the market stops caring about the fictional EBITDA and starts caring about the very real mountain of debt. The stock collapses 70% in a week. Frank is devastated. He doesn't understand what happened. He followed the expert. He bought the growth story. He looked at the number everyone told him to look at. He failed because he mistook the map for the territory. He mistook an accounting construct for business reality. This is the fate of the 99%. They chase the siren song of a simple, flattering number, and they crash upon the rocks of economic truth. The direct financial connection between this mental error and your portfolio's performance is stark and unforgiving. When a company highlights EBITDA, it's often because its other, more truthful, financial metrics are ugly. Let's make this tangible. Imagine two companies, Company A and Company B. Both operate in the same industry, and both report exactly $100 million in EBITDA for the year. The investor who only looks at this metric would conclude they are equally profitable. Now let's apply our reality check filter. We dig into the financial statements. Company A is a software business. Its capital expenditures for the year were a mere $5 million, mostly for new servers and office computers. Its assets are largely intangible: its code, its brand. Company B is a heavy manufacturing business. Its capital expenditures for the year were $80 million, just to maintain its aging factories and replace worn-out machinery. For Company B, that $80 million is not an optional growth expense. It's the cost of survival. It's the cost of having a business next year. The EBITDA of $100 million for Company B is a complete fiction. The vast majority of that cash flow is already spoken for. It doesn't belong to the owners. It belongs to the machinery vendors. It has to be reinvested back into the business, just to stay in the same place. This reality manifests directly on the balance sheet and in the company's strategic options. Company A, with its massive real cash flow, can pay a dividend, buy back its own stock, making each remaining share more valuable, pay down debt, or acquire other companies for cash. Company B has none of these options. It is on a capital expenditure treadmill, running as fast as it can just to keep from falling off. If it faces an unexpected downturn, it has no cushion. It will be forced to take on more debt or dilute its shareholders by issuing new stock just to fund its maintenance capex. Overlooking this distinction is the single biggest threat to portfolio protection. You might think you are buying a profitable enterprise when you are actually buying a capital-intensive utility that consumes cash. Focusing on EBITDA leads to a catastrophic misvaluation of the business, causing you to overpay for a mirage of profitability. This is not just a theoretical exercise. It is the core of due diligence, the very foundation of sound stock analysis and risk management. It is the difference between investing in a business that enriches you and one that slowly bleeds your capital away. Warren Buffett has a favorite analogy for executives and investors who tout EBITDA. He says, "Does management think the tooth fairy pays for capital expenditures?" This single, folksy question cuts through all the financial jargon and lays the issue bare. It's a scathing indictment of a mindset that has become frighteningly common in corporate boardrooms and on Wall Street. The quote attacks the absurd premise that the very real cash spent on maintaining and replacing a company's productive assets is somehow not a real expense. To Buffett, this is not just bad accounting. It is a profound intellectual dishonesty. He argues that depreciation is one of the most real costs a business has. It may be a non-cash charge on the income statement in any given year, but it represents the very real, very tangible decay of a company's assets, a decay that will eventually require a massive cash outlay to fix. Ignoring it is like owning a delivery truck and pretending that the wear and tear on the tires, the engine, and the brakes isn't a real cost of doing business, simply because you haven't bought new ones this quarter. It's an exercise in self-delusion. Buffett's entire career has been a testament to this principle. Look at the businesses he loves. He famously bought See's Candies in 1972. See's is a wonderful business for one very specific reason that relates to this principle. It requires very little capital to grow. The company generates huge amounts of cash, but it doesn't need to build massive multi-billion-dollar new factories every few years. The brand, not the physical plant, is the main asset. The cash See's generates can be taken out of the business and redeployed elsewhere into buying other businesses or stocks. Now, contrast this with an industry he has historically despised: airlines. An airline's primary assets are airplanes, which are fantastically expensive, have a limited lifespan, and require constant, costly maintenance. They are in a state of perpetual decay. An airline might report a positive EBITDA, but the vast majority of that number is an illusion, because it's already earmarked for the next engine overhaul, the next fuselage inspection, or the down payment on the next generation of planes needed just to stay competitive. The cash is trapped. It can't be given to the owners. This is the core of the issue. However, Buffett's genius is not in simply avoiding capital-intensive businesses. It's in understanding them so well that he can buy them when the price is right. His acquisition of the BNSF Railway in 2009 is the ultimate case study. A railroad is the quintessential capital-intensive business. It requires billions of dollars every single year for new locomotives, new rail cars, and the maintenance of thousands of miles of track. Most analysts looking at BNSF would have touted its EBITDA. Buffett did the opposite. He looked straight at the colossal capital expenditure budget. He didn't see it as a problem to be ignored. He saw it as a fundamental economic feature of the business to be analyzed. He understood that those expenditures were the lifeblood of the railroad, the cost of its durable competitive advantage. He didn't fall for the lie of EBITDA. Instead, he calculated the true owner earnings after those massive recurring costs. He determined that even after spending the billions required to maintain the network, the railroad still produced a satisfactory and growing stream of cash for its owners. He bought the entire company. He embraced the reality of depreciation and capital spending, while his competitors were either ignoring it with EBITDA or were too terrified of it to invest. He understood that the tooth fairy wasn't going to pay to replace 100-ton locomotives, and by pricing that reality into his valuation, he made one of the most successful investments of his career. He proved that it's not about capital intensity being good or bad. It's about whether you are honest about its cost. The psychological trap that Buffett avoids but so many others fall into is what we can call the abstract versus concrete fallacy. Our brains are wired to prioritize immediate, tangible, concrete information over long-term abstract concepts. Depreciation, as it appears on an income statement, is the epitome of an abstract concept. It's a non-cash charge. No money actually leaves the company's bank account in that moment. It's an accountant's estimate of decay. Because it's abstract, it's easy for our minds to dismiss it, to categorize it as not real. In contrast, the revenue number is concrete. The EBITDA figure is presented as a concrete measure of performance. We gravitate towards these seemingly solid figures. Capital expenditures, the cash antidote to depreciation, often occur in big, lumpy, infrequent bursts. A company might spend $2 billion on a new factory one year and very little the next. This irregularity makes it harder for our minds to process it as a consistent, recurring cost. EBITDA conveniently smooths all of this out. It takes the abstract concept of depreciation and makes it disappear entirely. It takes the lumpy, frightening reality of capital spending and pretends it doesn't exist. It serves up a simple, clean, and ultimately false picture of reality, because our brains prefer simplicity and cleanliness over the messy, complicated truth. Buffett's mind is different. He has trained himself to do the opposite. He sees the non-cash depreciation charge and immediately translates it into a future cash outlay. He sees the abstract accounting entry and visualizes the concrete reality of a rusting machine that will need to be replaced. This ability to connect the abstract accounting to the concrete business reality is a superpower. It allows him to see the true cost of doing business where others only see a flattering but fictional number. He respects the slow, invisible force of entropy, the universal law that things fall apart, and he knows it always, eventually, sends a bill. To operationalize this insight, you need a mental model that forces you to confront the reality of this decay. Let's call it the maintenance CapEx litmus test. This is a slightly more advanced technique than just looking at total CapEx, because it acknowledges a crucial nuance. Not all capital expenditure is created equal. Some of it is spent just to keep the business running. This is maintenance CapEx. The rest is spent to expand the business. This is growth CapEx. A company spending heavily on growth is very different from one spending heavily just to stand still. The challenge is that companies don't separate these two for you. But you can create a powerful estimate. Step 1 is to accept the premise that, at a bare minimum, a company must spend an amount equal to its depreciation charge each year just to offset the decay of its existing assets. Think of depreciation as the business melting a little bit each year, Maintenance CapEx is the cost of refreezing it back to its original state. Therefore, as a starting point, your estimate for maintenance CapEx is simply the company's annual depreciation and amortization figure, which you can find on the income statement or the cash flow statement. Step 2 is to refine this estimate by looking at history. Pull up the last 5 to 10 years of annual reports. Look at the total capital expenditures for each year. Is the company consistently spending an amount roughly equal to its depreciation charge? If so, it's likely that most of its spending is for maintenance, and it's not really growing. Is it consistently spending far more than its depreciation charge? This is a good sign that it is investing for genuine growth. Is it consistently spending far less than its depreciation charge? This is a massive red flag. It means the company is likely letting its assets deteriorate. They are underinvesting, and the bill for this neglect will come due in the future. Step 3 is to apply the litmus test to the company's profitability. Take their reported operating income and subtract your estimate of maintenance CapEx. Is the company still profitable? Does it still generate cash? A truly great business can fund all of its maintenance needs and still have a pile of cash left over for its owners. A mediocre business consumes all of its profit just to stay in the same place. A bad business, when viewed through this lens, is revealed to be losing money, even if its reported income is positive. This test exposes the economic engine of the business. It forces you to answer the most important question for any long-term investor. After paying to replace the worn-out tools, is there any money left for me, the owner? The path of the 99% is to be seduced by the simplicity of the phrase, "It's a non-cash charge." This is the mantra of the lazy analyst, the hopeful amateur, and the promotional CEO. When confronted with the large depreciation numbers of a capital-intensive business, they wave it away with this thought-terminating cliché. They see it on the income statement, note that it gets added back on the cash flow statement, and conclude that it's just some accounting fiction that can be safely ignored. They fail to make the critical mental leap. They fail to understand that the non-cash charge of today is simply the echo of a massive cash outlay from yesterday, the day the asset was purchased. More importantly, they fail to see that it is a direct prediction of a massive cash outlay in the future, the day the asset will inevitably need to be replaced. Let's imagine an investor looking at a trucking company. He sees that it earned $20 million in net income. He also sees a $15 million depreciation charge. He calculates the company's EBITDA as being well over $35 million. He's thrilled. Then he hears the dismissive mantra in his head. Depreciation is a non-cash charge. He ignores it. What he fails to comprehend is that the $15 million depreciation charge is the voice of the company's fleet of trucks, whispering that they are getting older, that their transmissions are wearing out, that their engines are losing efficiency. That $15 million is the portion of the fleet that was consumed in the process of generating the year's revenue. And soon, the company will have to go out and spend very real cash, likely much more than $15 million due to inflation, on new trucks just to maintain its current delivery capacity. The investor who ignores this is destined for failure. He will consistently overvalue businesses in industries like manufacturing, transportation, energy, and telecommunications, believing them to be cash-gushing machines when they are, in fact, cash-incinerating furnaces. He is ignoring the second law of thermodynamics, which applies to balance sheets as much as it does to physics. Things fall apart. And it always costs cash to put them back together. The financial connection here strikes at the very heart of valuation. How much is a business worth? The simple answer is that it's worth the present value of the cash it can generate for its owners over its lifetime. If you use a valuation multiple based on EBITDA, you are fundamentally breaking this principle. You are applying a multiple to a stream of earnings that doesn't actually belong to the owners. It belongs to the providers of capital. The I for interest and the T for taxes are real cash costs, and, most critically, to the business itself to fund its own survival, the D for depreciation. Let's say a company has an enterprise value of $1 billion and generates $100 million in EBITDA for a seemingly reasonable 10x EBITDA multiple. But if that company has $80 million of real, recurring maintenance capital expenditures, then its true pre-tax earnings available to owners are only $20 million. The real valuation is not 10x, but a staggering 50x owner earnings, $1 billion divided by 20 million. You thought you were buying a reasonably priced business, but you were actually paying a dangerously speculative price. This is how value traps are set. Companies that look cheap on an EBITDA basis are often ruinously expensive on a real owner earnings basis. Making this single adjustment to your valuation process, subtracting a realistic estimate for maintenance capex from whatever earnings figure you use, is the most powerful risk management tool you can employ. It will prevent you from overpaying. It will steer you away from businesses that are slowly liquidating themselves. It will anchor your stock picking in economic reality, not accounting fantasy, and in the long run, that is the only thing that creates real, sustainable wealth and provides genuine portfolio protection. In his 1986 letter to the shareholders of Berkshire Hathaway, Warren Buffett gave the world a gift. He grew tired of the distortions of standard accounting metrics, including GAAP net income, which he felt didn't accurately portray the true economic reality of his businesses. And so, he laid out his alternative, his preferred method for judging the performance of a business. He called it owner earnings. This was not just another metric. It was a revolution in perspective. It was designed to force the investor to stop thinking like a stock market speculator and start thinking like a true partner in the business. It answers the fundamental question: if I own this entire company myself, how much cash could I take out of it at the end of the year, while being sure that I hadn't harmed the long-term competitive position of the business? It is the holy grail of financial statement analysis. The definition he laid out was precise. Owner earnings, he wrote, is net income plus depreciation, depletion, amortization, and other non-cash charges, minus the average annual amount of capitalized expenditures for plant and equipment, etc., that the business requires to maintain its long-term competitive position and its unit volume. He also specified that you must account for any changes in working capital. Let's dissect this with the care it deserves, using the example of a business he owned at the time, the Buffalo Evening News. First, you start with net income. This is the official, audited profit from the income statement. It's the baseline. Second, you add back depreciation. Buffett understood that the non-cash charge of depreciation understated the cash-generating power of the business in a given year. The printing presses at the newspaper were depreciating on the books, reducing net income, but that wasn't cash leaving the building. So you add it back. This is where the EBITDA crowd stops. They get to a big, flattering number and declare victory. But this is where Buffett's genius and the work of a true investor begins. The third and most critical step is to then subtract the capital expenditures needed to maintain the business. This is the reality check. Buffett wasn't talking about growth spending. He was talking about the necessary amount to keep the printing presses running, to replace the delivery trucks, to ensure the newspaper could continue to serve its customers next year and the year after. He was effectively swapping an accountant's abstract guess, depreciation, for a business owner's real-world estimate of required cash spending. Finally, he accounted for working capital. If the business needed to tie up more cash in inventory or receivables to do the same amount of business, that was a cash cost to the owner and had to be subtracted. By performing this calculation, he arrived at a number that represented the true cash profit of the Buffalo Evening News. It was the money that he, as the owner, could genuinely pocket or use to buy other businesses without damaging the core enterprise. This simple but profound reframing from accounting profit to owner earnings is the key that unlocks a true understanding of a company's value. The psychological brilliance of this concept lies in its framing. By calling it owner earnings, Buffett triggers a powerful mental shift known as the ownership mindset, which is closely related to the endowment effect, the well-documented bias where we value things more highly simply because we own them. When you are calculating EBITDA or net income, you are an outside observer, a financial analyst playing with abstract numbers. But when you set out to calculate owner earnings, you psychologically place yourself in the shoes of the sole proprietor of that business. It's no longer a stock ticker on a screen. It becomes my factory, my store, my brand. This shift changes everything. Suddenly, the costs become more real. That capital expenditure line item is no longer just a number. It's the cash you, the owner, have to spend to replace the roof on your factory or upgrade your computer systems. You analyze it with the care of someone whose own money is at stake. You become naturally more skeptical and conservative. You are no longer asking, what is the number the market wants to see? You are asking, how much cash can I actually put in my pocket? This ownership mindset transforms you from a passive speculator into an active business analyst. It aligns your perspective with that of a long-term partner in the enterprise, which is precisely what a shareholder is supposed to be. It's a psychological judo move that uses our own cognitive biases to make us better, more disciplined investors. It forces us to focus on the long-term health and cash-generating power of the business, rather than the short-term fluctuations of its stock price. Now, let's translate this into a practical, step-by-step process. This is the owner earnings workout, a mental model you can apply to any business you are analyzing. It requires a bit of detective work, but the clarity it provides is invaluable. Step 1. Get the documents. You need the company's most recent annual report, the 10K. Don't rely on summary websites. Go to the source. All publicly traded U.S. companies are required to file these with the Securities and Exchange Commission, and they are available for free on their websites. Step 2. Find the starting line. Go to the Consolidated Statement of Earnings, also known as the income statement. Find the bottom line, net income. Write this number down. Step 3. Add back the non-cash charges. Now, go to the Consolidated Statement of Cash Flows. In the first section, Cash Flow from Operating Activities, you will find a line item, usually near the top, called Depreciation and Amortization. This is the number you need. Add this figure to the net income you just wrote down. Step 4. Subtract the real cash cost. This is the most important step. Still on the statement of cash flows, look in the second section, Cash Flow from Investing Activities. You are looking for a line called Capital Expenditures, or purchases of property, plant, and equipment. Now subtract this entire amount from your running total. Yes, this is a conservative approach, as it includes both maintenance and growth CapEx. For a truly deep analysis, you would try to estimate maintenance CapEx as we discussed before, but for a first pass, subtracting the whole thing is a safe and illuminating exercise. Step 5. Account for working capital. This is the most advanced step. You need to look at the consolidated balance sheet for this year and last year. Find total current assets and total current liabilities. Working capital is generally current assets minus current liabilities. You need to see how this number has changed from one year to the next. If the business required more working capital to operate this year than last year, that increase represents cash that was tied up in the business and is not available to the owners. You must subtract that increase from your owner earnings calculation. Step 6. Analyze the result. You now have a conservative but powerful estimate of the company's owner earnings. Compare this number to the net income you started with, and more importantly, compare it to the EBITDA that management and Wall Street are so proud of. The gap between the fiction of EBITDA and the reality of owner earnings is where savvy investors find their edge. It is the moat of clarity that protects them from bad decisions. The antithesis to this rigorous approach is the path of the 99%, the net income follower. This investor is more sophisticated than the EBITDA chaser. They've learned that EBITDA is flawed. They proudly proclaim that they only follow GAAP, generally accepted accounting principles, net income. They believe that because this number is audited and follows a set of rules, it must be the truth. They are closer to reality, but still living in a distorted world. They are playing checkers while the owner earnings investor is playing chess. The net income follower fails to appreciate the massive gap that can exist between accounting profit and real cash flow. A company can report beautiful, growing GAAP net income while simultaneously incinerating cash. How? Imagine a company that decides to stop investing in its factories. It cuts its capital expenditure budget to zero. Its machines get older, less efficient, and fall into disrepair. In the short term, what happens to its financials? Its depreciation expense stays the same. It's based on the historical cost of the machines, but its cash flow soars because it's not spending any money. Its net income might even look good. The net income follower sees the positive earnings and thinks everything is fine. The owner earnings analyst, however, would see a huge red flag. They would estimate the required maintenance CapEx, see that the company is spending nothing, and conclude that the business is hollowing itself out. They would understand that the reported profit is a fiction, created by liquidating the company's asset base. The net income follower is fooled by the stability of the accounting rules, failing to see how they can be used to obscure the dynamic, often brutal reality of business economics. They are focused on a snapshot, while the owner investor is focused on the long-term motion picture of cash generation. The direct financial connection of this principle is the ultimate prize in investing, a correct assessment of a company's intrinsic value. A company's value is not its stock price today. Its true intrinsic value is the discounted value of all the owner earnings it will generate between now and Judgment Day. That's it. That's the entire game. Therefore, the ability to accurately estimate owner earnings is the single most important technical skill an investor can possess. A company with high and consistently growing owner earnings is a compounding machine. This is the cash that truly belongs to the shareholders. Management can use it to pay dividends directly into your brokerage account. They can use it to buy back shares, which reduces the share count and makes your slice of the pie bigger and more valuable. They can use it to make smart acquisitions that will produce even more owner earnings in the future. Or they can reinvest it back into the business for high-return growth projects. These are the only 4 things that can create long-term shareholder value, and all of them are fueled by one thing: owner earnings. A company that has high EBITDA but low or negative owner earnings has none of these options. It is a financial mirage. By focusing your entire analytical process on this single, truthful metric, you align your investment strategy with the fundamental engine of value creation. You move beyond the realm of speculation and into the world of business ownership. This is the bedrock of wealth management, the blueprint for achieving financial freedom, and the final word on what makes a successful enterprise. While the fiction of EBITDA is a dangerous flaw in any industry, its power to deceive becomes catastrophic in certain sectors of the economy. These are the industries Wall Street loves to promote during speculative manias, the ones with grand stories and an insatiable appetite for capital. These are the industries of deception, where EBITDA goes not just to be misleading, but to tell spectacular, world-destroying lies. The game is always the same. A new technology or economic shift creates a compelling narrative of endless growth. Companies rush in, spending billions of dollars of borrowed money on physical assets to capitalize on the boom. To justify the spending and the soaring stock prices, they point to their magnificent EBITDA, a number made magnificent precisely because it ignores the colossal cost of those very assets. And for a time, the market believes them. The American shale oil boom, which took off in the early 2010s, is a perfect, brutal example. The narrative was powerful. Thanks to new technologies like hydraulic fracturing and horizontal drilling, the United States was on the verge of energy independence. A new American oil rush was on. Hundreds of companies, many of them new and loaded with debt, flooded into the shale fields of Texas and North Dakota. The capital expenditures were astronomical. Drilling a single shale well could cost millions of dollars. But the initial production from these wells was prodigious, so revenues soared. The problem was a dirty little secret of shale geology: the decline rates. A conventional oil well might produce for decades. A shale well, in contrast, produces furiously for the first year or two, and then its production plummets. This meant that to simply keep its overall production level flat, A shale company had to run faster and faster on a treadmill of drilling. It had to constantly spend enormous amounts of cash on new wells just to replace the production it was losing from its older wells. It was the definition of a capital-intensive business. So how did these companies present themselves to Wall Street? Through the magic of EBITDA. They would take their revenue, subtract their operating costs, and report a massive EBITDA figure. They were adding back the depreciation and, more specifically, the depletion charges associated with the oil they were pulling from the ground. They were telling the world, look how profitable our wells are, while completely ignoring the fact that the wells were rapidly dying and would require billions in new spending to replace. For several years, the story worked. Fueled by high oil prices and cheap debt, their stock prices soared. Analysts praised their EBITDA growth. But investors like Warren Buffett, who have always been deeply skeptical of capital-intensive commodity businesses where you are at the mercy of a price you can't control, largely stayed away. They understood the brutal math under the surface, and then, in 2014 and 2015, oil prices collapsed, the music stopped. Suddenly, the cash flow reality that had been hidden by EBITDA was laid bare. These companies were not gushing profits, they were gushing red ink. They couldn't borrow any more money, they couldn't afford to keep drilling. Without constant new drilling, their production collapsed. The result was a wave of bankruptcies that wiped out tens of billions of dollars in shareholder value. Investors who had been cheering the profitable EBITDA figures just a year earlier were left with worthless stock. They had been seduced by a number that was designed from the very beginning to hide the fatal flaw at the heart of the business model. The psychology at play in these industry-wide delusions is a toxic cocktail of herd mentality and the narrative fallacy. Herd mentality is our innate human instinct to follow the crowd, to assume that if everyone else is doing something, it must be the right thing to do. During the shale boom, every analyst on television was recommending these stocks. Every financial newspaper was writing glowing articles about the American energy renaissance. The stocks were going up. To stand apart from that, to be the person who said, wait a minute, what about the cash flow after capital expenditures, was to risk looking foolish. It's deeply uncomfortable to be a skeptic when the herd is stampeding towards what looks like a field of green grass. The narrative fallacy, a term coined by Nassim Nicholas Taleb, describes our tendency to create and believe simple stories to explain complex realities. The story of American energy independence was simple, powerful, and emotionally resonant. It was a much better story than the complicated, boring truth of capital-intensive businesses with high decline rates and negative free cash flow. EBITDA was the perfect statistic to support the simple, exciting story. It allowed investors to wrap themselves in the narrative without having to engage with the messy, contradictory details. When a powerful narrative combines with a stampeding herd, the result is a speculative bubble. The due diligence process is abandoned in favor of story time. And any metric, no matter how flawed, that supports the story is elevated to the status of gospel truth. EBITDA is the patron saint of narrative-driven investing. To avoid getting trampled by the herd, you need a mental model that acts as your capital intensity radar. This is a quick checklist you can use to identify the specific industries where EBITDA is most likely to be a weapon of mass deception. Run any potential investment through these 4 filters. Filter 1, the PP&E to assets ratio. Look at the company's balance sheet. Find the line for property, plant, and equipment, PP&E. Find the line for total assets. Divide PP&E by total assets. Is the resulting percentage high, say over 40% or 50%? If yes, this is a capital-intensive business. Its health and survival depend on the constant maintenance and replacement of these physical assets. Depreciation is a massive expense, and EBITDA will be exceptionally misleading. Think of industries like manufacturing, railroads, airlines, utilities, energy production, and telecommunications. Filter 2. The CapEx to revenue ratio. Look at the cash flow statement for capital expenditures and the income statement for total revenue. Divide CapEx by revenue. Is the company having to spend a large chunk of every dollar that comes in the door just on maintaining its asset base? While a high ratio can sometimes signal exciting growth, in a mature company, it often signals a brutal, low-margin reality. This is a sign that the business is a machine for turning revenue into new equipment, with little left over for the owners. Filter 3. The refresh cycle test. This is a qualitative test. Ask yourself, how often does this company need to buy expensive new stuff to stay in business? For a software company like Adobe, the refresh cycle on its core asset, its code, is long, and the cost is largely expensed as R&D. For a rental car company like Hertz, the refresh cycle is brutally short. Their entire fleet of cars has to be replaced every couple of years. The shorter and more expensive the refresh cycle, the more fictional EBITDA becomes. Filter 4. Be skeptical of industry conventions. Be extra vigilant when you find yourself analyzing a company in an industry where EBITDA is the accepted primary metric of valuation. This is especially true for telecommunications and media, where cable companies have long used EBITDA to obscure the massive cost of upgrading their networks, and in private equity, where financial engineers use EBITDA to justify piling enormous amounts of debt onto the companies they acquire. When a whole industry agrees to use a flawed metric, it's not because they are all stupid, it's because it is in their collective interest to present a rosier picture to the outside world. Your job as an investor is to reject that convention and seek the truth. The path of the 99% is to fall for the oldest and most dangerous lie in investing. This time is different. When confronted with the clear evidence that they are investing in a historically difficult capital-intensive industry, they will rationalize their decision by clinging to a narrative of change. They will look at an airline and say, yes, airlines have been terrible investments for a century, but this time is different because these new fuel-efficient jets completely change the economics. They will look at a shale driller and say, yes, oil and gas is a tough boom-and-bust business, but this time is different because fracking technology has unlocked decades of profitable production. They will look at a telecom company and say, yes, laying cable is expensive, but this time is different because the demand for 5G data is infinite. The phrase, "this time is different," allows the investor to acknowledge the brutal physics of a business model, the fact that big, expensive machines wear out and must be replaced with cash, and then to grant themselves a special exemption from that reality. They use the exciting new narrative to justify ignoring the boring old math. They fall in love with the story of the future and forget to check the bank account of the present. But the laws of financial gravity are immutable. Machines decay. Debt requires payment. Capital expenditures consume cash. This time is never different. The investor who respects this history, who respects the difficult economics of capital-intensive industries, will protect their portfolio. The investor who chases the siren song of a new paradigm, armed with nothing but a misleading EBITDA figure, is doomed to repeat the painful lessons of the past. The direct financial connection of this industry-level deception is to the risk of financial distress and bankruptcy. Here is how the trap is sprung. A company in a capital-intensive industry wants to grow, so it needs to borrow money to fund its CapEx. It goes to a bank or the bond market. The lenders, in turn, want to assess the company's ability to pay its debts. One of the key metrics they use is a leverage ratio, most commonly debt to EBITDA. A company can sustain a higher debt load if it has higher earnings. By presenting its inflated EBITDA figure, the company makes its debt load appear much more manageable than it actually is. It might have a debt to EBITDA ratio of 3x, which seems reasonable. Lenders give them the money. But the reality is that the company's ability to service its debt does not come from EBITDA. It comes from real free cash flow after capital expenditures. If the company's debt-to-owner earnings ratio is actually 15x, the situation is not reasonable at all. It is perilous. The company is balanced on a knife's edge. All it takes is a small downturn in the business, a drop in prices for its product, a new competitor, a recession, and its real cash flow can evaporate, leaving it unable to pay the interest on its debt. This leads to a cascade of catastrophic events. Credit rating downgrades, which makes borrowing more expensive. A collapsing stock price. which makes it impossible to raise new equity, and ultimately, a bankruptcy filing that can wipe out 100% of the shareholders' investment. Understanding where EBITDA is most likely to lie is therefore a supreme act of risk management. It is a tool for identifying and avoiding the companies that are most likely to blow up when the economic weather turns foul. It is a critical layer of portfolio protection against the most permanent form of loss. The relentless focus on owner earnings over EBITDA is more than just a superior accounting technique. It's the surface-level manifestation of a much deeper business philosophy, a worldview rooted in unshakable intellectual honesty, a commitment to long-term thinking, and a genuine partnership with the people who have entrusted you with their capital. It is, in short, an executive mindset, a philosophy of truth that separates the great business leaders from the mere promoters. When a CEO chooses to communicate with shareholders using the language of owner earnings, they are sending a powerful signal. When they choose the language of EBITDA, they are sending a very different one. There is no better embodiment of this philosophy than Warren Buffett and his partner Charlie Munger's management of Berkshire Hathaway. Their entire mode of communication is a masterclass in this mindset. The Berkshire Hathaway annual meeting is not a slick, scripted presentation full of buzzwords and, quote, adjusted non-GAAP metrics. It is hours of two old men sitting on a stage answering any question shareholders throw at them, speaking in plain English with astonishing candor. Their annual shareholder letters are legendary, not just for their wisdom, but for their clarity and honesty. You will not find the acronym EBITDA anywhere in their letters unless it is being mercilessly ridiculed. They do not talk like promoters, they talk like partners. And crucially, they are unafraid to admit their mistakes, often in excruciating detail. One of the most famous examples is the Dexter Shoe Company acquisition in 1993. Buffett bought the company for $433 million, paid for not with cash, but with Berkshire Hathaway stock. Soon after, foreign competition completely destroyed Dexter's competitive advantage, and the business's value went to zero. In his letters, Buffett doesn't hide this. He doesn't blame the economy or create a special adjusted earnings number that excludes the Dexter charge. He calls it, flatly, his worst deal ever, and quantifies the mistake not just at the $433 million purchase price, but in the multi-billion-dollar opportunity cost of what those Berkshire shares would be worth today. He writes, "I made a terrible mistake in buying Dexter." This level of honesty is the polar opposite of the CEO, who uses adjusted EBITDA to add back the costs of a failed acquisition or a restructuring that was necessitated by their own prior blunders. The Buffett and Munger philosophy is simple. We are owners. You, the shareholders, are our partners. We will report to you the way we would want to be reported to if our roles were reversed. We will give you the unvarnished truth, especially when it's ugly, because that is the only foundation upon which a lasting, trust-based enterprise can be built. The underlying psychological principle at work here is the profound power of trust and reciprocity. In any human relationship, from a marriage to a business partnership, trust is the essential lubricant. When it is present, everything is easier. When it is absent, everything is fraught with friction and suspicion. When a leader like Buffett communicates with such radical, unrelenting honesty, they are making massive deposits in the bank of trust. By refusing to use deceptive metrics like EBITDA, they are signaling to their shareholders, "We will not lie to you. We will not flatter you with fiction. We respect you too much to treat you like a fool." This act of respect and honesty triggers the deeply ingrained human principle of reciprocity. Shareholders receive this honest communication, and they reciprocate it with an equally valuable commodity: long-term loyalty. They become patient, understanding partners, not skittish, short-term speculators. They give the management the one thing that is most valuable in business: a stable, permanent capital base that allows them to make decisions for the 10-year horizon, not the next quarter. This is the float of trust. Contrast this with the company managed by a promoter CEO who is always hyping the stock and using fuzzy math. Their shareholder base will be composed of equally short-term thinkers. The moment the story falters, those shareholders will flee, creating volatility and pressure that forces management into even more short-sighted decisions. The commitment to intellectual honesty is not just a moral virtue, it is a profound and durable competitive advantage. To apply this principle as an investor, you must learn to perform a CEO honesty audit. This is a qualitative framework for judging the character and communication style of a company's management, which is just as important as analyzing their financial statements. Your goal is to determine if you are dealing with a partner or a promoter. Step 1. Read the last 5 years of the CEO's annual letter to shareholders. Is it written in clear, simple, direct language? Or is it a swamp of corporate jargon, full of words like synergies, leveraging, optimization, and platform? Honest leaders speak plainly. Obfuscators hide behind complexity. Step 2. Search the documents for their preferred metrics. Do they lead with GAAP net income and free cash flow, or is adjusted EBITDA the star of the show? If they use adjusted non-GAAP numbers, do they provide a clear and honest reconciliation and explain exactly why each adjustment is necessary? Or do they just present the flattering number as if it were fact? Step 3. Hunt for the admission of mistakes. This is the acid test. Read the letters and the conference call transcripts. Does the CEO ever, even once, admit to a mistake? Do they take personal responsibility for a decision that went wrong? Or is every failure blamed on external factors, the economy, the competition, the weather? Great leaders own their failures. Poor leaders are professional excuse makers. Step 4. Examine their compensation. Go to the company's proxy statement. Look at the executive compensation section. What metrics are their bonuses tied to? Are they rewarded for hitting an adjusted EBITDA target, a metric they can easily manipulate? Or is their compensation tied to metrics that are harder to game and better aligned with long-term shareholder interests, like return on invested capital, ROIC, or growth in intrinsic value per share? Step 5. Apply the ultimate gut check. After reading their words and examining their incentives, ask yourself this simple, powerful question. Does this person sound like someone I would want to be a 50-50 partner with in a local business for the next 30 years? Do I trust them? Your intuition here, grounded in this rigorous qualitative due diligence, is an invaluable guide. This is a vital skill, not just for retail investors, but for entrepreneurs and anyone involved in executive decision-making. The antithesis of this approach, the path of the 99%, is to fall for the cult of the visionary CEO. This is the investor who is seduced by charisma and a grand story. They see a CEO on the cover of a magazine, they watch their slick keynote presentations, and they confuse media savvy with business acumen. They get swept up in the personality and the grand promises of changing the world, and they completely neglect to do the hard, boring work of vetting the character of the leader. They don't read the primary source documents, the annual reports and proxy statements. They don't listen for the subtle signals of honesty or deception in the language. They outsource their trust to the media. They fall in love with the story and, by extension, the storyteller. This leads them to invest in cult of personality stocks, companies that are often built on a foundation of hype and unsustainable promises. When the inevitable gap between the grand vision and the messy operational reality becomes apparent, the story shatters, the charismatic leader is revealed to be flawed, and the stock collapses, leaving the believers in financial ruin. They forgot that in investing, you are not buying a story, you are buying a share in a business. And the single most important quality in the person running that business is not charisma, but character. The direct financial connection of this philosophy of truth is powerful and tangible. It results in a lower cost of capital and a higher quality of business opportunities. Because Warren Buffett and Berkshire Hathaway have spent more than half a century building a world-class reputation for integrity and intellectual honesty, the market affords them advantages that no other company on earth enjoys. Their cost of capital is lower, because lenders and partners know the numbers they present are real and that their promises will be kept. They are the buyer of choice for family-owned businesses looking to sell, because those families know that Berkshire will be a trustworthy steward of their life's work. They get phone calls with deal opportunities that no investment bank on Wall Street ever sees. Their reputation for honesty is a multi-billion-dollar intangible asset, as real and as valuable as any factory or railroad on their balance sheet. For you, the individual investor, the financial benefit of aligning yourself with this type of management is the ultimate form of risk management. When you invest with honest partners who communicate with clarity, you dramatically reduce the risk of catastrophic loss due to fraud, deception, or value-destroying capital allocation. You are insulating yourself from the most insidious risks in the market. The decision to reject the language of EBITDA and embrace the philosophy of owner earnings is therefore the final and most important step in building a truly resilient, protected, and profitable portfolio. It's an investment in the powerful compounding force of integrity itself. You have just spent your valuable time and attention absorbing a dense and powerful framework. Let's not diminish what you have accomplished. You have moved beyond the surface-level noise of the market and have acquired a deep structural understanding of how financial truth is obscured and how it can be revealed. You now possess a mental tool, the ability to distinguish between the fiction of EBITDA and the reality of owner earnings, that places you in the top tier of financial thinkers. You can now dissect a business with a clarity that the vast majority of market participants will never achieve. You've traded the comfortable lie for the profitable truth. But the journey into the mind of an investor like Warren Buffett does not end with a single tool. His system of thought is not a collection of isolated tricks, it is a seamless, interconnected latticework of mental models. You have just forged a single, crucial link in that chain. You understand how he analyzes the truth of a company's profits. But how does he determine what price to pay for those profits? How does he build an unbreakable defense against market panics? How does he identify the rare businesses that are truly built to last for a century? Each of these questions is answered by another, equally powerful model that connects directly to the one you have just mastered. The video that is now on your screen is not a random suggestion. Think of it as the next piece of the map. It is the component that takes your newfound understanding of a business's reality and links it to the actions you must take in the market. It is the bridge between analysis and decision. The choice to click is not about watching another video. It is a declaration of intent. It is for those who are serious about completing their mental arsenal, for those who are not content with a single weapon, but seek to become masters of the entire strategic framework. The journey to true financial sovereignty continues. The next link in the chain is waiting for you.